Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
C.H. Robinson was founded in 1905 as a produce brokerage in North Dakota. Today, it is the world's largest third-party logistics provider, matching shippers who need capacity with carriers who have trucks sitting empty.
The business model is non-asset-based. Robinson doesn't own the trucks. It earns a margin by finding the right carrier at the right price for each shipment, keeping the spread between what shippers pay and what carriers receive.
North American surface transportation is the core segment, handling over 20 million truckload, LTL, and intermodal shipments per year. It's an enormous network matching problem that Robinson solves at scale every single day.
The Navisphere platform is the technology moat. Once a shipper integrates Navisphere into their supply chain management system, it becomes deeply embedded, managing routing, tracking, carrier compliance, and invoicing in a single workflow.
Over 100,000 vetted carrier relationships in North America are the supply-side advantage. That density gives Robinson consistently better capacity access than smaller brokers, particularly during tight freight markets when capacity is scarce.
Robinson Fresh is the perishable specialization. Cold chain logistics for produce, dairy, and meat requires carrier relationships, refrigerated equipment expertise, and time-sensitive coordination that generalist brokers struggle to match.
Global Forwarding handles international air and ocean freight, connecting the domestic trucking strength to cross-border trade flows and enabling Robinson to serve multinational customers across their entire logistics footprint.
The freight brokerage business is highly cyclical. During tight capacity markets, broker margins expand as shippers pay premiums. During loose markets, shippers push back on pricing, and carriers demand less, compressing the spread Robinson captures.
On the competitive radar, Robinson competes against Expeditors, J.B. Hunt, and digital freight brokers. The scale of Robinson's carrier network and the breadth of shipper relationships are difficult for newer technology-led entrants to match immediately.
Dave Bozeman became CEO in 2023, tasked with navigating the post-pandemic freight downturn and modernizing the technology platform to compete against digital native brokers while protecting the incumbent scale advantages.
The dividend has grown for 25 consecutive years, a remarkable streak for a cyclical business. Management has maintained the payout through multiple freight downturns, reflecting confidence in the normalized cash generation through the full cycle.
Net revenue, gross revenue minus carrier payments, is the profitability driver. Robinson earns approximately 20% net margin on gross freight dollar flows, meaning the quality of the match and negotiating leverage determine returns.
Operating in over 40 countries, Robinson connects global supply chains. The international footprint matters as multinational shippers increasingly want a single provider managing both domestic trucking and cross-border ocean and air freight.
The long-term structural case for freight brokerage is growth in outsourcing. As manufacturing supply chains become more complex, shippers increasingly prefer asset-light brokers over managing carrier networks themselves.
That's the company chapter for C.H. Robinson. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
C.H. Robinson just delivered a first quarter earnings beat that signals something important. The freight market recovery is not just a hope. It is showing up in the numbers. The company earned $1.35 per share against an estimate of $1.24, an 8.9% beat, the kind of beat that gets attention. The context matters enormously here. C.H. Robinson is North America's largest freight broker, and it spent 2023 and 2024 grinding through one of the worst freight downturns in decades. Volume was weak, spot rates were depressed, carrier counts collapsed, and margins compressed. The recovery was always going to come. Freight is cyclical, and this quarter is the clearest evidence yet that the inflection has arrived. But the real question is whether this recovery is durable or just a temporary bounce. Today we unpack that question. Ticker
C.H. Robinson Worldwide is North America's largest freight broker and one of the largest third-party logistics providers globally, headquartered in Eden Prairie, Minnesota. The company operates as a pure-play freight intermediary. It connects shippers who need to move goods with carriers who have capacity to move them, without owning the trucks, planes, or ships. Revenue in the traditional sense is gross revenue from shippers. The net revenue or gross profit, after paying carriers, is what the company actually manages and grows. The largest segment is NAST, North American Surface Transportation, which handles truckload, less than truckload, and intermodal shipments across the continent. The company also has global forwarding operations for air and ocean freight. Its market capitalization is approximately $21 billion. C.H. Robinson is asset-light by design. The model scales without major capital investment in physical infrastructure.
First quarter 26 results. C.H. Robinson reported adjusted earnings per share of $1.35, beating the consensus estimate of $1.24, an 8.9% beat that was broad-based rather than driven by any single unusual item. Total revenue came in at $4.0 billion for the quarter. The net revenue margin, which is the critical measure of how much Robinson earns per shipment, improved meaningfully year over year, signaling that the pricing recovery is taking hold. NAST, the core North American surface transport segment, showed the clearest improvement. Volume trends were positive, and the combination of recovering spot rates and operational efficiency gains contributed to the earnings beat. CEO Dave Bozeman, who joined in 2023 to execute a turnaround, has been implementing cost reduction and automation programs, and those investments are beginning to show up in the per-transaction economics. The guide for the rest of the year was constructive.
The income statement structure for C.H. Robinson is distinctive and requires some translation. Total revenues of $4.0 billion represent the gross amount shippers pay. Purchased transportation, what the company pays to carriers, is subtracted to arrive at net revenues or gross profit, which is the true measure of the company's business volume and pricing power. That net revenue line is what management and analysts focus on. Below the gross profit line, the major expenses are compensation, Robinson's large workforce of freight brokers and technology staff, and operating costs including technology investment. The cost reduction program that CEO Bozeman initiated has been focused on right-sizing the cost structure for a business that overhired during the freight boom of 2021 and 2022. Headcount reductions and automation in the brokerage function have improved the cost per transaction metric, which is Robinson's operational efficiency benchmark. Interest expense is modest given the relatively clean balance sheet.
The signature competitive moat for C.H. Robinson is scale, and in freight brokerage, scale compounds in ways that are genuinely difficult to replicate quickly. The company moves over 20 million shipments per year across North America. That volume gives Robinson access to carrier capacity that smaller brokers simply cannot match. It also generates data, real-time visibility into freight rates, carrier availability, lane performance, and shipper demand patterns that informs the pricing and matching algorithms that drive the business. The Navisphere technology platform is the operational backbone, and the company has been investing heavily in automating more of the brokerage process that was historically manual phone and email work. Every automated transaction is structurally lower cost than a manually brokered one. Scale also enables deeper relationships with the largest shippers, Fortune 500 companies that want a broker with the capacity and reliability to handle complex, high-volume shipping programs across multiple modes and geographies simultaneously.
Cash flow and balance sheet. C.H. Robinson generates solid free cash flow through the freight cycle, though the amount fluctuates with working capital as freight volumes change. The asset-light model means capital expenditure requirements are low, primarily technology investment, so the conversion from earnings to free cash flow is high relative to asset-heavy logistics operators. The balance sheet is in reasonable shape, with debt to EBITDA at moderate levels. The company has historically returned capital aggressively to shareholders through dividends and buybacks, which is a reflection of the free cash flow generation and limited need to reinvest in physical assets. The dividend yield is in the 2 to 3% range and has been maintained through the freight downturn, which speaks to confidence in normalized free cash flow generation. Working capital is a significant balance sheet line given the receivables from shippers and payables to carriers. In a recovery environment, receivables grow with revenue, so working capital investment is a natural use of cash during growth phases.
Capital returns. C.H. Robinson has been a consistent and aggressive returner of capital over its history, primarily through share repurchases and dividends. The dividend has been maintained and grown over time, currently yielding in the 2 to 3% range. During the freight downturn of 2023 and 2024, buyback activity was reduced as management prioritized balance sheet flexibility and operational investment in the turnaround. As the recovery progresses and free cash flow improves, buyback activity is expected to increase. The asset-light model means there is no competing need to reinvest capital into trucks, warehouses, or physical infrastructure. The primary capital use beyond buybacks and dividends is technology and personnel. That clean capital structure is one of the most attractive features of the freight brokerage model for long-term investors. Management has historically been disciplined about not pursuing acquisitions at elevated prices, preferring organic investment and technology capability building over M&A.
Management and catalysts. CEO Dave Bozeman arrived in 2023 as a turnaround-oriented leader with an operational background, and his execution so far has centered on 3 pillars: cost discipline, automation, and customer focus. The automation initiative is the most strategically important. The goal is to dramatically increase the percentage of shipments that are priced, booked, and managed without human intervention, reducing cost per transaction and improving margin. Quarterly earnings reports are the primary near-term catalyst cadence, each quarter that shows improving net revenue per shipment and declining cost per transaction validates the thesis. External catalysts include freight market tightening as trucking capacity contracts. Smaller carriers that overexpanded during the boom are exiting, which is reducing supply and supporting spot rates. Tariff-driven trade uncertainty is a short-term wildcard. It is increasing shipper demand for brokerage flexibility, which is a positive for Robinson, but sustained tariff disruption could reduce overall freight volumes, which would be a negative.
Analyst sentiment on C.H. Robinson is cautious. The consensus is hold, with a price target around $92 against a current price near $85. That is roughly 8% upside, which is meaningful but not compelling on its own. The hold consensus reflects a genuine debate in the analyst community about how much of the recovery is already priced in. The stock has moved significantly from its lows during the freight downturn, and some analysts believe the easy money has been made. Bulls point to the operational improvements under Bozeman as structural, not just cyclical, meaning the company emerges from the downturn with a structurally better cost structure, not just a cyclical revenue recovery. Bears argue that digital freight brokers and Amazon's logistics build present competitive threats that the street has not fully risk-adjusted for. A few analysts have moved to buy on the back of the strong Q1 beat, arguing that the consensus is too conservative about the pace and durability of the recovery.
Valuation at $85 per share, C.H. Robinson trades at approximately 25 to 27 times trailing earnings, which looks expensive in isolation but needs context. Freight brokerage earnings are highly cyclical, and the trailing earnings figure reflects a depressed freight environment. On normalized mid-cycle earnings, what Robinson would generate in a balanced freight market, the multiple is more reasonable in the 15 to 18 times range. Price to gross profit is another useful lens. The company trades at roughly 1.5 to 2 times annual net revenue, consistent with mid-cycle historical norms. The key valuation debate is whether the current stock price is discounting a full recovery or something more modest. If freight continues to tighten into 2027 and net revenue margins recover toward historical peaks, the stock has meaningful upside from current levels. If the recovery stalls, the current multiple looks stretched. The dividend provides some support, But this is fundamentally a bet on the freight cycle and Robinson's execution.
Bull case number one. The freight cycle recovery is early and durable, not late and fragile. Freight cycles typically run 3 to 5 years from trough to peak. The 2023 to 2024 downturn was severe, among the worst on record in terms of rate compression and carrier exits. The recovery from troughs of that depth tends to be extended, not a quick snap. Carrier capacity has been contracting as smaller operators exit the market due to sustained operating losses. This supply reduction takes time to reverse because buying new trucks and hiring drivers is slow and expensive. Meanwhile, demand, driven by consumer spending, industrial production, and tariff front-loading activity, has been recovering steadily. When capacity contracts and demand recovers simultaneously, freight rates typically move in one direction, up. For every dollar of spot rate improvement, Robinson's net revenue per shipment improves proportionally. The operating leverage in a recovering freight market is one of the most powerful earnings dynamics in all of transportation and logistics.
Bull case number 2. The operational turnaround under Dave Bozeman is creating structural margin improvement that will persist through the cycle. During the freight boom of 2021 and 2022, C.H. Robinson overhired. When the downturn hit, the cost structure was too heavy for the revenue base and margins compressed badly. Bozeman's response was systematic cost reduction combined with accelerated investment in automation, specifically moving more shipments from manual brokering to algorithm-driven pricing and booking. The cost per transaction metric has improved materially, and if the automation initiative continues to deliver, C.H. Robinson will emerge from this downturn with a structurally lower cost structure than it had entering the downturn. That means higher margins at every point in the next cycle. This is not just a freight recovery story. It is a story about a business becoming fundamentally more efficient, which creates durable competitive advantage and expands the earnings potential at the peak of the next cycle.
Bull case number 3. Tariff uncertainty is actually a near-term tailwind for freight brokers. The instinct is to assume that trade policy uncertainty hurts freight volumes, and over the long term, significant tariff barriers would reduce cross-border trade flows and hurt the global forwarding segment. But in the near term, tariff uncertainty does something interesting. It makes shippers more willing to pay for flexibility. When trade routes and customs costs are changing unpredictably, shippers do not want to be locked into fixed carrier contracts. They want the ability to reroute, remode, and retime shipments quickly. That is exactly what a sophisticated freight broker provides. C.H. Robinson's value proposition, access to more than 100,000 carrier relationships, real-time rate visibility, and multimodal flexibility, is directly enhanced by supply chain uncertainty. Shippers who had reduced their reliance on brokers during the stable, capacity-heavy years of 2022 and 2023 are re-engaging with broker relationships as the environment becomes more complex.
Bear case number 1. Digital freight brokers and technological disruption pose a structural threat that the market has not fully priced in. Uber Freight, Convoy before its closure, Transfix, and a growing roster of venture-backed digital freight platforms have been attempting to disintermediate traditional brokers like C.H. Robinson for over a decade. While the closure of Convoy is often cited as evidence that digital-only models cannot compete, the broader digital freight trend is ongoing. More importantly, large shippers are increasingly building direct digital connections to carriers using freight matching technology, and carriers are investing in their own direct shipper technology. If technology reduces friction in direct shipper-to-carrier matching, the middleman brokerage position that Robinson occupies becomes less valuable. Robinson is investing in its own technology to stay ahead, but the pace of external disruption is not under management's control, and the structural margin from information asymmetry, knowing rates better than shippers or carriers, is narrowing over time.
Bear case number 2. Amazon's logistics build is a slow-moving but serious competitive threat. Over the past decade, Amazon has systematically built out its own freight and logistics capabilities. A massive fleet of delivery vans, Amazon air cargo operations, regional fulfillment hubs, and increasingly, a third-party freight network through Amazon Freight. Amazon is not trying to put C.H. Robinson out of business. It is trying to control its own logistics costs, which are enormous. But as Amazon becomes a larger player in freight, it increasingly competes for carrier capacity and, in some segments, for shipper customers. More importantly, Amazon's logistics ambitions create a future where the largest e-commerce companies do not use brokers at all. They own the logistics stack end to end. The low barriers to entry nature of freight brokerage means that any large, technology-enabled player with sufficient scale and capital can replicate much of what Robinson does. Amazon has both, and it has every incentive to reduce its dependence on third-party intermediaries.
C.H. Robinson is at an inflection point. The freight market recovery is real and showing up in results. The 8.9% earnings beat in Q1 is not noise, it is signal. The operational turnaround under Dave Bozeman is delivering structural efficiency gains that should persist through the next cycle. The scale advantage, the carrier network, and the Navisphere technology platform provide durable competitive differentiation in a fragmented industry. The risks are genuine. Digital disruption is a slow-moving but real structural threat. Amazon's logistics ambitions cannot be dismissed, and the low barriers to entry nature of brokerage means the competitive environment is never static. At $85, the stock price is in a meaningful recovery, but perhaps not a full mid-cycle normalization, which means there is more upside if the cycle continues to improve, and modest downside risk if it stalls. The hold consensus reflects that balanced risk-reward honestly. For investors with conviction on the freight recovery and patience with execution risk, C.H. Robinson offers a compelling entry point into North America's largest freight network at a reasonable cyclically adjusted valuation. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall